Peter Lynch Investing Tips. When he took over the Fidelity Magellan Mutual Fund in May of 1977, his first job as a portfolio manager, the assets of the fund were $20 million. In the early 1980s, a young portfolio manager by the name of Peter Lynch was becoming one of the most famous investors in the world, and for a very understandable reason. When he took over the fund, the assets of the fund were $20 million. He proceeded to convert it to become the largest mutual fund in the world between the years of 1977 and 1990, exceeding the market by an astounding 29% per year annualized over this time period. Lynch was able to achieve this goal by using several fundamental concepts, all of which he was more than eager to explain to absolutely anyone. Peter Lynch was adamant in his belief that individual investors had inherent advantages over large institutions. He reasoned that large institutions either wouldn't or couldn't invest in smaller cap companies that have not yet received significant attention from analysts or mutual funds. Individual investors, on the other hand, could invest in these companies. Whether you're an individual investor trying to enhance your returns or a registered agent trying to find good long-term options for your clients, we'll introduce you to how you can use Lynch's tried-and-true technique. Peter Lynch's 3 basic investing tenets. When Lynch's outstanding success while managing the Magellan Fund attracted the kind of extensive attention that is customarily the result of outstanding performance, he penned a number of books articulating his views on the subject of investing. Although they are fascinating to read, his primary argument can be summed up using only 3 primary points. Number 1. Only buy what you understand. According to Lynch, our eyes, ears, and common sense are the 3 most valuable instruments we possess for conducting research on the stock market. Lynch was quite pleased with the fact that many of his excellent stock ideas came to him while he was simply going about his daily activities, such as shopping or having casual conversations with his friends and family. When we watch television, read the newspaper, or listen to the radio, all of these activities provide us with opportunities to engage in first-hand analysis. When we are out and about doing other things, such as driving down the street or going on vacation, we may also be thinking of new ways to invest our money. In the end, consumers are responsible for 2/3 of the gross domestic product that is generated in the United States. In other words, the majority of the stock market is in the business of serving you, the individual consumer. Therefore, if something appeals to you as a consumer, it should equally pique your interest as an investment opportunity. Number 2. Always do your homework. Anecdotal evidence and first-hand observations can be very helpful in getting started, but in the end, every excellent concept needs to be backed up with solid research. Do not be misled by Peter Lynch's apparent homey simplicity when it comes to conducting thorough research. Peter Lynch's success was built on a foundation of meticulous investigation. As a follow-up to the initial glimmer of a fantastic idea, Lynch emphasizes many fundamental qualities that he expected to be met for any stock that would be worth purchasing, including the following. A proportion of total sales. If there is a product or service that initially drew you to the company, you should make sure that it constitutes a high enough percentage of sales to be meaningful. A great product that only makes up 5% of sales isn't going to have more of an impact than a marginal impact on a company's bottom line. If there is a product or service that initially drew you to the company, you should make sure that it comprises a high enough percentage of sales to be meaningful. Ratio of the PEG. It is important to look at this ratio of price-to-earnings growth rate in order to determine how much anticipation is already built into the stock. You should look for companies that have strong earnings growth and reasonable valuations. A strong grower with a PEG ratio of 2 or more has that earnings growth already built into the stock price, leaving little room for error. You should look for companies that have strong earnings growth and reasonable valuations. Give preference to businesses that have healthy cash reserves and debt-to-equity ratios that fall below the norm. The corporation has alternatives available to it in all different kinds of market scenarios because of its robust cash flows and cautious asset management. Number 3. Invest for the long run. Lynch has remarked that over a period of 10 to 20 years, the performance of equities is generally predictable, provided that there are not many shocks. If you want to know whether they will be higher or lower in the next 2 or 3 years, you might as well just flip a coin. It may come as a surprise to learn such statements came from a Wall Street icon, but the fact that he so strongly believed in his views is demonstrated by his statements. He maintained his familiarity with the businesses he owned, and so long as the story hadn't evolved, he refrained from selling his shares. Lynch did not attempt to time the market or make predictions regarding the general trajectory of the economy. In point of fact, Lynch previously carried out a research project to investigate whether or not market timing was a profitable approach. According to the findings of the study, an investor who had put $1,000 into the market on the day that historically represents the highest point of the year every year between the years of 1965 and 1995 would have seen a compounded return of 10.6% over the course of the entire 30-year period. If a second investor makes the identical investment of $1,000 each year on the same day of the year for the same period of time, then that second investor would get a return that is compounded annually of 11.7% over the course of the 30-year period. Therefore, after 30 years of the worst conceivable market timing, the first investor only fell behind in his returns by 1.1% per year. This was the case despite the fact that the worst possible market timing occurred. As a consequence of this, Lynch is of the opinion that it is not even worth the effort to attempt to forecast the short-term changes of the market. If the company is healthy, it will bring in more money, and the value of the shares will go up as a result. Lynch was able to direct his attention on the most important task, which was finding great companies, since he kept things as straightforward as possible. Lynch is credited with having first used the phrase 10-bagger to refer to a stock that increased in value by a factor of 10 or 1,000%. When he was managing the Magellan Fund, these are the stocks that he was searching for to invest in. The first and most important rule for spotting a 10-bagger is to avoid selling the stock after it has gained 40% or even 100% of its value. In today's market, many managers of investment funds are looking for ways to reduce their exposure to profitable equities by either selling them or trimming their holdings in such stocks. According to Peter Lynch, this amounted to picking the flowers and watering the seeds. The bottom line. Peter Lynch's performance and stock-picking expertise speaks for itself. Despite the fact that he ran the risk of over-diversifying his fund, he owned hundreds of stocks at some moments. He became an expert in observing his surroundings and gained a grasp of the world in both its current state and potential future states. Through the application of his teachings and our own observations, we may increase our knowledge of investment while interacting with the world around us, which will make the process of investing more pleasurable and profitable. What do you think of our video? Please let us know in the comment section below. If you enjoyed this video and want to hear from me again, please subscribe and turn on the notification before leaving. Thanks for watching.